Good evening. This is the Elliott Wave update for the S&P 500 for Sunday, April 17th, 2022. I hope everybody had a great weekend. I apologize for the misinformation on Thursday's update suggesting that there was a Globex session and that it would cover us through Friday morning or actually Friday early afternoon if you're on the East Coast. That did not happen. I neglected to realize that Good Friday is an important holiday around the globe. So often within the European markets, it is a two-day, a Friday, Monday holiday. So it's a two-day holiday. So they may be closed tomorrow. Again, I don't know. We'll see. In any case, I was a little bit not taken back by Thursday's trade, but Thursday's trade did not end the way I suspected it would. In fact, here in the S&P, it appeared that the early expiration, the one, the morning expiration for the S&P did go off without a hitch. They bought it up. But once that was done, it was like, okay, all the sellers were like, okay, we're out of those positions, boom. And they just, it basically went down from there through the balance of the day. And instead of being bought up at the close, it was sold at the close. That is following through here as we start the Globex session. So right now, the S&P is down about 26.5. The Nasdaq's down 126 and 127.5. Excuse me, it's bouncing around. And the Dow is off about 152, 153 points. Now, what does all this tell us? Well, one thing I wanted to do and then did not is I'm going to be removing the minute degree count. And now I'm going to just drop it down to the hourly so I can do it cleanly. And the reason is that because I am satisfied with the market having done what it has done, and so I'm willing to take off the internals and leave it on in the minor degree. Because essentially, as I move out to that daily chart, it gets too clogged up if I include the lower levels, so like a minute, a sub-minute, et cetera. So those would be for the hourly, the 30-minute chart, and for clarification purposes mostly. But it's pretty obvious. We get a 1, 2, 3, 4, and then a 5. Now, what we did leave off with is the potential that the market was going to do an A and then a B and then a C wave, and we'd still end up back above the highs that we saw on Wednesday, at which they did do. We got up to 44, 55, 56. So we'd need to go above that level to finish the minor wave 2. But instead, we've come down and we've broken below minor wave 1. We've broken the low that we saw within that minor wave 2. And currently, we've reached a low, I believe, at 43.60 or just below, 43.59. So that kind of tells us that minor wave 2 is more than likely complete. Because first of all, it would be a B wave going in the wrong direction to create a new low. And because of the degree and because it is a second wave versus a fourth wave, I am pretty clear about the wave 2 or wave 2 limitations. And since it's correcting wave 1, that would be, for me, the limitation. When it starts to break it, then I'm going to have to feel that the correction that it's within is complete. And that larger trend, which would be expected to break it, is back in force. So 1, 2, now we're into a third. One other thing to note, I may be bold, I may be stepping out on the limb, but I've added a next higher degrees completion of a supercycle wave 3. I've been talking about it, but I've left it conveniently off the chart. Now I'm being bold enough, I'm going to go ahead and put it back up there. And so I believe that that is the completion point for the intermediate, the primary, the cycle 5th waves, and the supercycle 3rd wave. So again, as I've been talking about, we're in a supercycle 4th wave correction. This correction should take us 10 to 12 years from start to finish. So we're in its infancy. This Supercycle Wave 3 began in 1942. So we're correcting a lot of advance, a lot of bullishness, a lot of everything. We've had economic collapses in there. We've had a crash in there. We've had a couple of crashes actually in there. So a lot was within Wave 3. And so we're going to be correcting for a while. We're in the very beginning stages. So we have completed, at least on the daily chart, 5 waves down, which are labeled of the minor degree. That was the excellent start. That's how I look. That's what I start to look. And once I can get it, I'm getting more confirmation that indeed we are in a larger, more complex, longer term corrective phase. Again, I'm going to state it, and this, if I'm stating the obvious, I apologize, but there will be fantastic trading opportunities in both directions at many, many times over the course of the days and the weeks and the months and the years that it takes for this to all unfold. And I'm talking about numerous trading opportunities for the day trader, for the swing trader, for the position trader, whether it's a 2-day position or a 2-month position or a 2-year position. There will be plenty of trading opportunities to cover all bases. There will be tremendous downside moves. There will be tremendous upside moves because, again, of the degree of the correction, B waves are going to be spectacular. In fact, the one that will come after we come all the way down to, and I'm just quickly going to go out there because I'm giving a quick review. I believe that our first leg down of this supercycle degree corrective phase, which will be on a cycle degree, and then if I get one more time, I think down to the primary degree, I believe either one of the two, but we're going to end up back here at the low of March of 2020, which is the pandemic low, the pre-pandemic low, because really the pandemic was just kicking into gear. And then suddenly somebody came in and said, well, we're just going to pump the system so full of dollars that we have no choice but to go up. And that's pretty much what happened. And that then completed the whole cycle, as a matter of fact. And now that this, if anything, is what we're really truly correcting. We're correcting this finishing move on a primary degree. And that started, this one started in 2020 up to 2022. So first we're really correcting the last 2 years of rally. That's just for starters. Then we can go out and keep going out to where each one of these completed. So we haven't gotten up. So if we're just coming down to where we're putting in our first primary degree move, we haven't really gotten up to the cycle and then up to the super cycle. So this is why it's taking time. I'm looking for this completion point of this A wave, the primary degree A wave, to put in that first 5 down of an intermediate degree. So again, I'm up here, but it's within the intermediate degree. So intermediate 1 and 2 are complete. We're into that intermediate third wave down, which has tremendous potential. Now that's the one that I put on. So this is the intermediate degree Fibonacci extensions. So let's take a look at that before we break it down and we get into the inside of how this is starting. So I continue to look and say that the S&P has the potential and a high probability of dropping down to the 34, 87, 85, 90 into that area, that support zone, which will build around it, which represents that intermediate wave 3, which is now in force, will find support and come in at a Fibonacci 1.618% times the length of the intermediate wave 1. Now, having said that, this is the most common within each of these cycles that happen now. So that's the intermediate degree. And we're in the intermediate third, which is going to be the longest and strongest on the intermediate degree impulse move. And then I can go up on the primary degree impulse move. If we end up being in the third wave at some point somewhere, it will be the longest and the strongest. But as we can see here within the minor degree, it certainly was. It was the longest and the strongest. So within the intermediate degree, it's going to be the longest and the strongest. As that it breaks down, we're in the minor third of the intermediate third. It should be the longest and the strongest. So these will just present pauses, places to catch our breath and rest as the market ultimately drops down to within this zone, to be honest with you, from 3,758 down to 3,485. And the first true area which could possibly put a cap on it would be 3,925-ish. And that's where intermediate 3 would be equal to wave 1. But that puts a lot of pressure on wave 5, to be honest with you. But I digress, going back. So I don't normally look for that. It is a support zone nonetheless, and it does have Fibonacci significance. So 39.25 would be a minimum that I'd be looking for all of this to get to. So I think that we start to pick up the pace again. And it took a little bit, but yep, that's kind of what's happening. And as we get around a little bit, another 15 minutes, we start to see those Asian markets open. If they're going to jump on our same bandwagon, what I think truly is happening is that now that we got that expiration out of the way, it wasn't as tilted towards the buy side as I thought it might be, but it does seem that the focus is now back on the reality. And the reality is inflation is high, and it is really eating away at us, the consumers, and that the market likely going to have to start paying attention to it in a more realistic fashion as to what happens in a higher interest rate environment. What happens when interest rates go up? Well, of course, being that it's at the top of that pecking order, the pecking order that I call that this, what absolutely conquers all. You know, you want to play rock, paper, scissors. Well, you've got the pecking order, and it's called interest rates. So you could say equities, you know, precious metals, or equities, currency, interest rates, and play that same rock, paper, scissors. But every time you got interest rates, you won, because interest rates control everything, because it just trickles down. And what we're now witnessing is that here we are sitting up at the major one. We're looking at the longer term interest rates, the short term interest rates, the ones that the Federal Reserve, our government, hands out. So what people can borrow at and what people will get paid to lend is very important. And if we don't pay attention to it, or if we ignore it, or say it's baked in, it's a very unrealistic statement to make, in my opinion. Because how would we possibly know it's baked in? As if having the lowest interest rates that really capped off last year, they topped or bottomed, you know, the yields, the interest rate that was being given on the 2-year note and the 10-year note and the 5-year note were below 1%. Now, when you compare that and you just look at the downward slope, the yield absolutely dropping like a stone from 1981. Well, that was the last period where we had to jack up the interest rates to put a cap on inflation. Ever since, we had to inflate because we were in trouble, because the only way out was to pay for it. Again, you know, we went through the economic collapse of 2008, 2009, and during that period, it was the Federal Reserve, it was the federal government that bailed out corporations. They didn't come after or offer assistance. They took it to the corporate level, who then again, they expected to trickle down and pay the rest of us who were part of the workforce, who, you know, et cetera, et cetera. So those subsidies didn't drop down to that level. Fast forward to 2020 and moving forward, we were shut down because of a virus that had no treatments, and was absolutely packing every emergency room, every hospital, every ICU. We were short of ventilators. We were short of medical protective equipment. We were short, et cetera, et cetera, et cetera. And the death toll started to mount. And there was no help in sight. There was no light, even a glimmer, even a flicker at the end of that tunnel. So we went down. And what happened is that we got shut down. We had to stay home. We couldn't go out. We couldn't go to the grocery store. We had to have all these things brought to us. Well, they cost money. Many people lost their job. So where did that funding then become from the government? That stimulus came to us, the consumer. And we had to have it. Otherwise, we truly would have gone under. We would have seen people, we would have seen bankruptcies, we would have seen default on loans, default on mortgages, default on car loans, default on everything. And it really would have just upended the economy and pretty much ended it. Now we've just delayed it and we're paying for it because we put out $6.3 or $4 trillion in stimulus to keep the economy afloat. And this happened around the world. Now, what we're seeing is like, what's the result of that? Well, we have inflation and it's coming home to roost. It's hitting us pretty hard. And it's not going to stop. So a 1/4 point interest rate rise, which is all we've gotten so far, out of a potential 7 that they talk about this year. And everybody wants to say it's all baked in. What a line. How, I just don't understand how that can be even conceived or conceivable, because it just has not trickled down. It's just no way. So, okay, so that's the reality. And that's what I think the market is beginning to understand. Not that I believe that some of the larger players, these bigger banks, they've known, but we're dealing with a bunch of banks that could be in trouble because of their positions, because of derivatives, blah, 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 blah. A lot of stuff going on. So what's the S&P telling us? So I got the 3. We're right in the start of this third wave. That is where I think the intermediate third wave can come down to. Now I'm going to slip this down to the hourly chart. I'm going to take this off so we're not getting confused, and I'm going to keep it up, but I'm going to now put on for the minor third wave. That's the more one in need right now, because this is what I believe we're going to go to. Now I'm going to put that top right there, and I'm going to show you again that on Thursday in that, come on, let's just see if we can get this thing right. Put it right, come on. Jeez Louise. Yeah, I will get it in a second. I think I got it. Okay, so on Thursday, I talked about that from the opening, and here it was. We drifted lower, and then we spiked. That was the opening. And then that was it. We flipped, and we fell after that. Drop real quick to the 30-minute, and you'll see it. Opening, boo, plop. Little buying, plop, plop, plop. Little buying, plop. You know, it just went down. The power was to the downside, and they weren't giving up. So back up to that hourly chart. That was it. That's where wave 2. So that's where the third wave began. So we're just really in its infancy. And I'm going to call it that way because, number one, it's coming below the 43.84, which was the low so far of that internal sequence. But then it broke below the completion point for minor 1. Once it starts breaking below 43.75, it really kind of puts the cap up there and starts to signal that this is the next segment. Now, again, remember, what am I saying? Third waves, longest and the strongest. Well, let me just go one more 30 minutes so I can start to open up these bars a little bit and we can see them. See what it is, red, 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 red. It's a third wave. That's what I'm looking for. So again, so if we're day traders and you're coming in tomorrow and you're going to day trade, what we're going to be looking for is the larger moves to be we're exiting positions. And if bids kind of dry up, well, remember that the orders go to value. Value is wherever it's bid. in this particular case. If you're a seller, you're looking for the bid. That's the value. And they might be thin. It might just kind of, you know, okay, I'll buy one there and the next one's all the way down. We don't know yet. We'll see. But I suspect that we'll continue to drop as all of the additional markets begin to open and start to participate. Again, having the, you know, a 3-day weekend, basically. A lot of things to factor in, a lot of stuff still going on. So for tomorrow, I actually do believe that we're going to continue to head lower. Yes, it won't go straight down. So we will see a lot of, you know, we'll get bounces. But of note, here we are back on the hourly chart. That's the 200, then the 50, then the 20. The 20 crossed over that 50, crossed below it. That was one thing I was looking for on Thursday. I wanted to see it, which was going to give additional confirmation that we're likely just going to keep heading lower once you get your moving averages breaking. Now, look at the downward slope. The 20, pretty strong. The 8, very strong. The 4, of course, the shortest term, is pointing straight down. This is almost vertical. This is getting vertical. And even the 200, which was actually a strong resistance way up here, sloping. Now we're getting caught. Then it was a little stronger resistance there. Now you see how it's coming in. It's putting resistance at 44.60. So which is a fair pop from here, but you're going to see it starts to get capped off, and the upside starts getting capped. Then it continues to put downside pressure on the market. I know it's strange to think about, but it's true. Now, going to go out to that daily real quick. Let's look at those moving averages, see what they look like. They're still kind of jumbled up. We still have the 200. We have the 8 beginning to head down below that 200. That will continue to show that on the daily chart, we're going more negative. We broke the 50, the 20 is sitting right at the 50, and both are at that 44.46 area. Yeah. 44.46, which was a nice support area prior, but now it's a resistance area. And so once they start to cross, it adds additional on a daily chart negativity. So going down the sequence on the time frame, it's putting pressure on the hourly, puts pressure on those shorter term charts, and that all trickles up to the daily. So the daily begins to agree with the negativity in the market. We got the 8 getting ready to break that 200. When they start to drop, and the 200 is the top side, and then the 50, and then the 20, then the 8, as we saw on the hourly, then the daily is giving us a very strong negative signal for continuation. Okay, so tomorrow I'd be looking for some more downside action. It could get heavy. So be prepared. And the reason we kind of go over it this way and put it together with the Fibonacci is because the Fibonacci's will, you break one, look for the next on down, etc. And then for upside, we break and then look for to that same resistance. Like we're breaking above and below the 382. It's just a pause. That's what it's providing. So we go up above, we break back above. If it breaks hard enough, we might rally back to 43.95. Might. Again, but on the break, strong enough, I'm looking for 43.27. Well, 57 is just 30 points, but 30 S&P points. So these things become tradable. And so you can look at option trades. You can look at a lot of different things and participate in the market going down. Same issue for when it's going up. We'll have a count, we'll have Fibonacci, we'll have moving averages, and you can put that together and you work your trades. They could be day trades, they could be small swing trades, they could be an overnight swing trade, etc. Lots of things to do all the way up and down in our markets these days. Okay, I'm going to finish up there. So again, updated the count, updated the labeling, clean things out so that we can see exactly what's going on. We can see where the moving averages are. We can more clearly. And right now we're working a minor third wave. When it becomes necessary to take a peek to see where we are in terms of the intermediate, I will replace and put back that intermediate degree third wave Fibonacci extensions. Right now, don't need them. This is where our focus is. All right. Have a great trading day tomorrow. And the next update will be on Monday, April the 18th.